Hello, I'm Andrew Keane from Edison, and it's my pleasure today to welcome James Smith, manager of the Premier Miton Global Renewables Trust, to talk about the fund he manages and the sector more generally. James, welcome.
Hi.
James, let's start with the renewables market in general. Which subsectors are you more bullish about, more bearish about within the broader market?
Well, primarily I invest in operational renewable energy assets, so wind farms, solar farms, and companies that build and operate them. Geographically, there's a lot of attractive areas at the moment. I would pick out the US, very strong electricity growth coming from the technology sector. So they're building new data centers. And particularly if the data center is using artificial intelligence, they have a huge demand for power. And those companies prefer to contract with renewable energy, both for their own carbon footprint. But as you know, renewable energy being a largely fixed cost generator is able to offer fixed price long-term contracts. So that's attractive. So we're seeing good growth in the States. I think Europe is also quite attractive at the moment in the sense that we've come through this very turbulent period post the Russian invasion of Ukraine in 2022. And of course that pushed energy prices, particularly electricity prices, to very high levels. And they've come back down. But they've kind of settled at a higher level, which is attractive for renewable energy generators. But we're seeing less volatility in the European market, and I'm hoping that will lead to a positive investing environment for the sector. So I think both Europe and the States are both very attractive at the moment.
And how does that translate into your particular fund? I mean, what kind of portfolio changes have you made in the past year? Are there any particular changes you want to highlight?
In terms of individual areas, we have been building up some European positions and also the States. I mean, if I can mention individual companies, for instance, AES Corporation in the States, they are seeing very strong demand for large-scale renewable energy assets coming from the technology sector. In Europe, we're seeing some good numbers coming out of some of the larger renewable energy companies. We've seen a good positive offshore wind auction in the UK. So I think any company with exposure to offshore wind is attractive at the moment. So SSE, for instance, RWE in Germany. So we've been focusing attention on those. Other areas that I think perhaps often overlooked and a way that we can maybe add a little value are subsectors such as offshore wind turbine installation vessels, for instance. So now one of the top 10 holdings in the fund is a company called Cadella, which is the market leader. And the interesting thing about offshore wind, of course, is that the turbines have increased so much in size. So there is quite a shortage of the very large vessels that are capable of installing the new generation of offshore wind turbines. So that's a change that we've made to the portfolio, and so far performing quite well for us.
So in addition to geography and technology, there's also the issue of development stage, whether or not you're investing in firms taking on development risk, or whether they're more operating in yield cos, so to speak. How do you view that in the current environment?
Yeah, so for the benefit of people who aren't necessarily familiar with the terminology here, there are two very broad categories of renewable energy company. So the first one you mentioned, yield cos, which stands for yield companies or investment companies. And of course, we have a few of those in the UK, like Greencoat UK Wind, for instance. And their business model is to buy and then operate renewable energy assets. And they pay out a large share of their cash flow to investors in the form of a dividend. Now, the other type of renewable energy company is a company that actually develops renewable energy assets. And what we mean by develop is go from first concepts, let's think about building a solar farm over here, and take that through the planning process, the environmental approval process, grid connection, etc., through to an operational asset. And they may well then own that asset, or they may sell the asset to an investment company, for instance, or maybe a combination of both, sell a part of the asset. Now, we own both types of those within the portfolio. The advantage of the yield cos is that they give you a strong yield, which we can then pay to our investors. But if you think about the returns over the entire life cycle of a renewable energy asset, the development stage is higher risk and therefore typically attracts a higher return. So we have actually been taking on some more developer type companies within the portfolio, trying to boost those risks, returns, maybe at the expense of slightly higher risk, but we think the returns available are more than justify doing that. So that's been something that we've been looking at quite closely.
And how does the interest rate environment come into that decision? Because yieldcos were very attractive in a low interest rate environment. We've seen interest rates come up now, potentially lowering, but we're not really necessarily seeing a full reversion in that curve. How does that play into not only your thinking, but perhaps investors' thinking into, are they going to become relatively more attractive as interest rates fall?
Yeah. Well, as you know, the sector has been quite a poor performer over the past few years in that increasing interest rate environment. I hate the term, but often you might hear some investors say bond proxies.
Yep.
And they're referring, of course, to things like utilities or property, and of course, these days, renewable energy, because the cash flows from a renewable energy asset are quite predictable, lower than average risk. Investors often view them as having bond-like characteristics. So it's no surprise that when interest rates have been increasing, the sector hasn't done particularly well. So if we are going into an environment where interest rates coming down, then all else equal, that should be positive for the sector. So in terms of the UK companies, for instance, we've seen them go from a premium to net asset value to a discount to net asset value. Now, it's probably worth saying that net asset values themselves, and these are what the companies, those yield companies, say the portfolio is worth, haven't actually changed a great deal, despite the interest rates environment going up. And what they're doing is that they are, as I'm sure you're aware, they are coming up with a discounted cash flow calculation to try and value their assets. So as interest rates go up, you discount those future cash flows at a higher rate, and you have a lower current valuation. And the market understands that. What the market hasn't understood, though, is that those cash flows themselves will be higher, because interest rates have only been high because inflation's been high. And a lot of the revenues within the sector are inflation linked. So those two effects have kind of, for the most part, offset each other, although the market has really been over-focused on interest rates, in my view. So I guess to summarise, the interest rate environment isn't nearly as important as people think it is on a fundamental basis. But from a trading markets basis, the direction of interest rates is actually quite important. And I'm hoping now we're heading into a far more benign environment.
You've talked about offshore wind and some of the other sectors. Battery energy storage, and it's an important part of the infrastructure solutions for energy transition, but it's had a difficult year. I mean, what are your views on that as a sector?
Battery energy storage, it's worth understanding what it's for. It's there to manage short-term volatility on the electricity grid. Now, in the UK, that's kind of managed through largely competitive markets, and it's been rather cyclical. So for a few years, we didn't have quite enough battery energy capacity to manage those flows, so it was very well remunerated. And now we probably have slightly more than we need, so the returns have gone down. And if you look at those battery energy storage companies in the UK, the share prices were very high, and now they're quite low. But like with any cyclical industry, you reach a low point, investment stops going into the industry, and then prices recover. So where we are on that stage, I'm not entirely sure, but I don't think things can get much worse than they have been over the past 12 months, for instance. It's worth noting that in other areas of the world, batteries are a much more regulated asset. So typically what would happen is the local grid company, the local distribution company will put out a tender and you will build a battery asset, a battery storage asset, which will then have a contract for pretty much all its revenues or a large part of its revenues. So in the States, for instance, the battery energy environment is far more, I would say, lower risk than it is in the UK. So it does depend on where in the world you're talking about.
We talked a little bit before about the discount to NAV that's come out with rising interest rates. With the funding model for a lot of firms in this sector, that makes it very difficult for them to raise capital at a discount to NAV. So you're seeing firms looking at things like recycling capital or potentially taking on some debt. I mean, do you think that the discount to NAV is actually a hindrance to getting capital into the sector for growth?
Well, it obviously is, because these companies can't really issue new shares at a discount to their published net asset value. I mean, my own view, for what it's worth, is that these companies, although they are publishing a net asset value, what is that net asset value? It's just a discounted cash flow valuation. In the same way that you as an analyst for years have been doing discounted cash flow valuations of operating companies and saying it might have a price target of $5 or whatever it is. And the market says, well, that's very interesting, but we're going to use a PE or another form of valuation metric, and we're going to value it at $3.50. And I think that's what's happening within the sector. So I guess that then leads you on to the question is the investment company model maybe the right one for those companies going forward? And I don't have an answer to this. But I think unless things pick up, unless we're seeing more capital coming into the sector and seeing those premiums restored, I mean, it doesn't have to be a big premium, but anything above NAV, then they won't be able to raise new capital, and they will have to look at other ways to fund their development. And what we've seen in the investment company sector is that all the time they are becoming more and more like a normal renewable energy company. So they're going up the value chain, they're doing more development work. So the first thing they used to do, they always used to buy operational assets. And then in order to try and generate a higher return, they started buying assets at the ready to build stage. And now we're seeing a number of them actually owning or having agreements with renewable energy developers to go even further upstream. So you begin to think, well, the line between a normal renewable energy company and an investment company is becoming increasingly blurred all the time. And for me, I don't make the distinction really. I'm happy to own either. What I'm doing is I'm looking at the fundamental value of what we actually own and ignoring how the market labels it or how they happen to account. Do they account like an investment company or like a standard corporation? I'm trying to look through that because I think that just is causing confusion.
Lastly, just on general, it's a very general question on fashion. Renewables have been perhaps slightly out of fashion, as a thematic sector, despite the high growth. What do you think are the general catalysts that bring broader investors back into the sector? Is it changing power prices, further growth, changing interest rates? Is it a combination of those factors?
I think it's definitely a combination. Interest rates coming back down will undoubtedly be a huge help. In Europe, we're still seeing this post-Ukraine environment where politicians, they used to be very concerned about the environment, the carbon emissions. Now they're more concerned about security of supply. So having renewable energy generated within Europe rather than importing large amounts of gas from Russia. And of course, climate change is still with us and is becoming increasingly important. And then we have things like electricity growth. And as you know, for many years, demand for electricity has been falling as we've used electricity more efficiently. And now it's going to start rising because of data centers, electrification of transport, electrification of space heating, whatever it is. Now, all those trends are fundamental, important, permanent structural shifts, and they're not going anywhere. And as long as they are there, renewable energy will be in demand and it will continue to grow. So we just kind of need some of these shorter term factors like interest rates to kind of be onto the back burner, and then the market can concentrate on the real fundamental value of what we actually have here. And that is, the only energy sector that really is growing and showing fundamental long-term appreciation of value.
James, thanks for joining us today and sharing your views.
My pleasure.
For any further information, please look to the Edison website for further details. Thank you.